The most brutal recession is coming. So what's next? Let's look back into history to better understand the situation. The end of the great financial crisis of 2008. Governments around the world, including Europe, US, and Japan, intervened to prevent a financial contagion by buying toxic assets and utilizing their balance sheets to stabilize the economy. This led to the rise of the pseudo-scientific economic theory called the modern monetary theory, which states that governments can continue to print money and introduce it into the economy to drive long-term growth. Fast forward to 2022, and we see the consequences of this approach. Governments around the world have printed around $30 to $35 trillion of money into the economy that should never have been there. This has led to a distortion of true supply and demand, and now all of that money needs to be destroyed in some way to restore economic equilibrium. Now, to the economic bear market that's currently taking place. It will likely take 24 to 36 months for the true price of assets to be revealed, and the market may be choppy for a while. Additionally, there are concerns that the Fed's data on inflation is unreliable, as it relies on random sampling and outdated methods of calculation. This may lead to higher CPI in the next few months, potentially reaching as high as 7 to 9%. The next few months may be difficult and uncertain, but emphasizes the importance of understanding the background and context of the current economic situation. The audience is advised to buckle their seatbelts and be prepared for a long and drawn-out process of restoring economic equilibrium. As the economy continues to grow and become more complicated, the stakes of financial stability are getting higher and higher. One of the biggest challenges we face is rising costs, particularly in the area of rent and natural gas. According to industry experts, rent works on a 3-month lag, and the true owner's equivalent rent is set to be reintroduced into the Consumer Price Index. That means that we can already forecast that the CPI will go up. But that's not the only concern on the horizon. Russia is currently trying to destabilize Europe by messing with their natural gas supplies. The German energy minister recently stated that if this continues, it could have a contagion effect similar to the collapse of Lehman Brothers in 2008. With all these factors at play, prices are likely to continue to rise, and this puts the Federal Reserve in a difficult position. How can they maintain credibility when inflation is at 8 or 9%? The answer is that they will overcorrect, and this could lead to even more problems. All roads seem to lead to lower equity prices, as we've already seen in the first wave of market fluctuations. But now this problem is going to touch all other areas as well. For example, as a country, we've become too dependent on debt. One of the most obvious areas where this is evident is in the financing of private equity leverage buyouts. These companies are often on the brink of insolvency, and private equity firms lever up their balance sheets with debt, pricing them right into the edge of what's legally allowed or financially feasible. But all of this depends on the economy continuing to grow. If it doesn't, we could see a contagion in the debt markets and in the commodity market. Another story that illustrates the complexity of this situation is what happened to Facebook 2 days ago. While the S&P and Nasdaq were up, Facebook was down by 400 points. This is significant because it shows that most informed buyers in the stock market, the institutional hedge funds, are starting to reevaluate their positions on big tech companies like Facebook. They realized that the price-to-earnings ratio was not as cheap as they thought, and if they pass through all of these increases in inflation and energy expectations, Facebook could fairly be valued at a lower price. This is important because eventually other stocks will also go through earnings revisions, and this could lead to a repricing of the entire world of equities at a lower price. Wall Street has done a poor job of warning retail investors about this, and the average estimates of earnings are expected to be record-breaking next year, but that's not realistic. With inflation at 8 or 9%, companies won't be able to pass through these costs, and they will lead to fewer jobs and fewer people to buy things. Earnings are also likely to go down this year and next year, and this is going to put enormous pressure on non-profitable tech companies. We're facing a complex and challenging economic environment with rising costs, inflation, and a dependence on debt. The stakes are high and the solutions are not easy, but it's important that we understand the issues and work together to find a way forward. A government official acknowledged the need to protect consumers through securities laws, but also recognized that providing too much financial power can lead to irrational spending. They then note that the recent influx of money in the economy has led to a spike in the stock market, but now the Federal Reserve will have to remove that value, leading to a significant drop in the stock market. The official goes on to discuss the state of the economy, mentioning that we're currently in the beginning stages of overcoming a recession and the effects of a war, and that it will take some time for these issues to be resolved. They also expressed confusion as to why anyone would give up their liquidity at this time. The official then shifts to discussing the situation in Russia and Ukraine, stating that it appears that the United States may have engaged in a proxy war without discussion, and that Europe is now facing an economic contagion as a result. They predict that the endgame will likely be a negotiated ceasefire and détente, but that Russia has effectively won economically. The official then criticizes the United States' economic sanctions against Russia, noting that they were ineffective and porous and that Russia's economy is now thriving while America's is not. They also express concern that Russia and China are now trading and settling in CNY, which could have negative consequences for America's role as the reserve currency. The official suggests that America's attempts to economically humiliate other countries will continue to fail, and that this approach could lead to a negative consequence for the American economy. At the same time, other countries will see it as an opportunity for economic prosperity. That's all for this video. Hope you liked it. If so, hit the like button and subscribe to Monetary Overwatch and turn on the notifications so you never miss a video. See you in the next one. Till then, take care and thanks for watching.